are joined by Chuck Lieberman of Advisors Capital Management. Chuck, always good to have you on.
Thanks.
You said that the Europeans finally got the message this past weekend, but are they actually going to do anything about it now? I mean, they got the message.
They got the message, and it looks like they're really seriously talking about doing something, talking about potentially putting capital into the banks, definitely putting a fence around the sovereigns that they consider to be at risk. And interestingly, they even so far suggest that Greece will be inside that firewall instead of being left outside. So I think they really did get the message.
That's a big difference, you're right. But as we look at the board right now, the Dow only up about 134 points. That's 200 points off the high. So is the U.S. still concerned that not enough is being done? Is that the message of the market today?
Well, I think we have to wait until we see them actually implement. Talking is one thing, doing is clearly something else. They have not yet done what they need to do, but at least they seem to know that they need to do it. We need to see them implement.
Now, have you been buying stocks over the past couple of days on this sell-off as we've come back now? You're doing okay?
Yeah, we have started to buy. We've got a lot of cash. We've been sitting on some cash for a couple of months now, but it looks like it's beginning to move in the right direction. I don't want to wait until they cross the T's and dot the I's. I want to start buying.
You know, that's a good point, Chuck, and I think Adam brings up a good point about how, you know, we've seen so much of the rally go away today. A viewer writing in about Europe, and he says, you know, we cannot change because of European political and economic structures that cannot be changed till there's a massive crisis. I mean, there's fundamental problems that aren't going to be fixed overnight. I mean, this is going to weigh on the markets for some time, don't you think?
Yes, exactly. But at the same time, what we need to do is get away from the fear, the threat of default. So once we see that they really are standing up and supporting the banks and standing up and supporting the sovereigns, we don't have to get the budget deficits down to think that we're in good shape.
I'll ask you just before the closing bell, what kind of names you were buying? So let's get specific. What's been on your shopping list?
Well, we have a number of names on our shopping list. We've got some of the industrials. We like the auto sector.
And when you're talking industrials, are we talking Honeywell? Are we talking ITT?
Honeywell's on our buy list. GE's on our buy list. Magma, Ford, they're all on our buy list. We think they're great, solid companies, and they will participate in recovery.
Hey, guys.
I want to give you a chance here. Mark made a very key point, and that is 6 times we've gone up to 1220 on the S&P, haven't been able to get through there. Does that give you some concern as you're buying some of these stocks on the cheap?
Not at all. He's a trader. I'm an investor. I don't care about his short-term outlook. That's a very, very funny way to look at it. I see stocks as being ridiculously cheap, very, very cheap. And as long as the Europeans finally get their act together, that's going to be very, very positive. It's going to clear away a lot of the primary concerns that are driving stock valuations down to current levels. So I think of this as a long-term buying opportunity.
Well, if 1220 is the upside, 1120 has been the downside support. What happens if the Europeans don't get it together and we go through 1120? Then what do you do?
Well, I don't care about the level. I care about if the Europeans don't get it together. If the Europeans don't get it together, then concern is going to increase across the board. Our concern will increase. We'll perceive much greater risk to the economy. We would then become a seller. But if the Europeans make their progress, and it doesn't have to happen quickly, it doesn't have to happen consistently, they just have to continue to grind towards a solution where they stand up behind their banks and stand up behind their sovereigns. As that occurs, we gain confidence, and that increases our willingness to buy.
But, you know, let's remind everybody, you know, we're focusing so much on Greece, but as you guys are bringing up, it's not just Greece, it's how much this spreads. We actually talked to PIMCO's Mohamed El Arian. He gave Bloomberg an anatomy lesson on the Greek crisis. Listen up.
Greece is like the toe that got infected. It wasn't dealt with, and therefore the infection spread throughout the whole body,
right,
and is now threatening vital organs. Greece is a toe. It's no longer an issue about Greece. I think it's an issue about the rest of the body.
I mean, Chuck, when all is said and done, it's taken us over 2 years to even deal with, you know, get to some kind of point with Greece, and we're still dealing with this. What comfort, what hope do you have that we're going to be able to deal with the rest of Europe in a timely manner? I know what everything's being said and that there's pressure on the European officials to do something, but, you know, what hope do you have that this is actually going to get done in a timely manner, because it hasn't so far?
Well, just because it hasn't doesn't mean they won't finally get the religion and get going. Obviously, the IMF meetings were very significant. Everybody and their uncle told the Europeans that they can't continue to twiddle their thumbs while Rome is burning, or in this case, while Athens is burning. Athens is a small part of the issue. It's really only a very small country. The real issue, of course, is contagion, and that's why we get back to that question of providing support for the banks so that if there's a write-down of Greek debt, the banks have the capital to support it. If the other Europeans, the other sovereigns are supported, again, that helps us gain confidence that contagion is going to be contained. So it's the rest of Europe, it's the rest of the banks that they really have to get behind. Whether Greece is on the right side of that wall or the wrong side of that wall is less important to me than that the Europeans erect the wall around the countries and banks that they want to preserve. And as they make progress in that direction, that gives me confidence.
All right, hang on, guys, for a second. You know, Suzanne, I want to bring you into this conversation. We've had some mixed signals today in the so-called safer havens. Talk us through what you're seeing.
Yeah, you know, Carol, we definitely had a divide. You know, on one hand, we had gold rallying the most in 7 weeks. There was a sense that gold just got too beaten down or oversold. But also, don't forget, gold is also considered a safe haven as well, gaining about 3.6% to $16.52 an ounce. But then on the other hand, as stocks rallied, we had that so-called risk-on view today for investors, and they continued to sell bonds. We saw treasuries under pressure today. That pushed yields on the 10-year and the 30-year long bond higher. This is an interesting trend because it's been a reverse of course, what we've seen over the past couple of weeks. And Chuck, my question for you is, we're just a few days away from the fourth quarter. You mentioned you have a lot of cash. Are you going to be applying some of that cash to bonds or gold, or are there more opportunities in stocks, or do you want to protect your portfolio as we get to the end of the year?
Well, we're actually moving out the risk curve in the fixed income market. We're buying more high yield. We're actually selling some very high grade paper. In the equity market, we're putting cash to work. We stay away from gold. We have no idea whatsoever what that investment or trade is all about. When the market was selling off, gold got clobbered. So today the market is up and gold is up. It's very difficult to assess what drives the gold market. Clearly, fear is one of the variables, but it can change and turn 180 degrees in a minute's notice. In terms of analysis, we're comfortable with the notion that as the global economy gets support, that's long-term good for equities.
Chuck, I got to ask you about valuation, and you mentioned a report from J.P. Morgan that you read earlier this morning. Talk to me about that.
Well, the report compared valuations in the market today to valuations at the absolute low of the market in March 2009. And whether you look at price to book, price to earnings, other measures, prices today, valuations today are very, very close to where they were at the absolute bottom of the market in March 2009. That tells me the stock market is very cheap, and it's actually discounting horrific outlooks. Remember, back in March 2009, we were fearful about a possible depression. I think the risk of a depression today is recognized as considerably lower. Many people don't even think that it's particularly likely we'll have a recession. So valuations are cheap.
So you would make the argument, same valuation as 09, but less risk, it's a buy.
Exactly.
Hey, Chuck, I want to get to some of your picks and let's get a little bit of background. Julie, one of Chuck's picks is a hotel company. It's getting beaten up big time this year.
That's right, especially in the past month and a half or so as we've seen the market fall off. It's Hershaw Hospitality. It's a real estate investment trust, owns a number of different hotels, especially in the Northeast, in urban centers, and definitely has fallen off, as you can see from the chart, in the past couple of months or so. I know one of the reasons Chuck likes it, though, and a lot of investors have been drawn to stocks like this. It has a pretty high dividend yield, about 6.8%. Now, that's a lot more than you're getting paid to hold treasuries, that's for sure, and to hold a lot of other different stocks and different assets. Chuck, I would ask you, though, I mean, when it's got a downward trajectory, sure, you're getting the dividend yield, but your total return is still negative if the stock falls by enough. So do you see a turnaround coming for this company?
Sure. Well, you're looking at it as a trader, and you're looking strictly at the price of the stock. We're looking at the company and the fundamentals. This is a company over the last couple of years that has paid down debt at the same time that they've increased substantially their corporate cash flow. They've got a dividend that's covered very substantially by their cash flow. They have the ability to raise their cash flow if they're so inclined. What they've been doing instead is using that free cash flow to pick up more hotels at bargain prices. Then you look at sales and revenue, and you see the activity is actually increasing. It's very promising.
All right, Chuck Lieberman, Advisors Capital Management. Thanks as always for joining us. Glad to have you. Carol?